Good afternoon, good morning, and good evening, everyone. Thank you for taking the time to join the Abaxx investor call. Just before we begin, the call is being recorded. To any of those who cannot attend or who have to drop off quickly, we will provide a recording. Before we begin, I do want to put out a disclaimer and a forward-looking statement. Just give a minute for everyone to read this. Perfect. Without further ado, I'd like to introduce everyone to Neil Simon, CEO and founder of Investor Cubed.
Thank you very much, Jan. Good morning, everyone. Thank you for attending today's Abaxx Technologies webinar. For those of you who don't know me, I'm Neil Simon, the founder and CEO of Investor Cube. Since 2004, we've had the privilege of working with some truly exceptional companies, but Abaxx is in a league of its own. I've had the pleasure of collaborating with Abaxx since 2020, even before they went public, and I can say without hesitation, it's one of the most exciting opportunities I've encountered. At Investor Cube, our staff and associates are all proud shareholders of Abaxx. We believe the company holds tremendous potential and an opportunity that, in our view, comes around only once in a generation. Today, I'm joined by Abaxx founder and CEO, Mr. Josh Crumb, and the Chief Commercial Officer of Abaxx, the Abaxx Exchange, Mr. Joe Raia. They will bring you up to date on Abaxx's journey, particularly since the launch of the Abaxx Commodities Future Exchange and Clearinghouse, where trading commenced on June 28th this year. During today's presentation, they'll dive into formative technology, infrastructure Abaxx has developed in pursuit of smarter markets. As someone who speaks regularly to Josh, I can tell you every conversation leaves me excited, very excited about what Abaxx is building, where the company's headed. Their achievements over the past 6 years are nothing short of remarkable. My personal perspective is I'm astounded that we are currently trading at such a low valuation. I'm pleased to also inform everybody that the former Global Head of Commodities Research at Goldman Sachs, Dr. Jeff Currie, is joining today's call, who currently serves as an independent director on Abaxx's board. He joins us today to provide his thoughts on the company, why he joined the board, and where Abaxx technology and infrastructure supports today's changing commodities landscape. We also want to congratulate Jeff on recently joining the Carlyle Group as the Chief Strategy Officer of Energy Pathways. Carlyle has well over $400 billion in assets under admin, is one of the largest private equity firms in the U.S. Exchanges and marketplaces are some of the most important and valuable companies in the world. For reference, I've been watching ICE's journey over the last many years. ICE IPO'd in 2005, saw their market cap on the first day of trading hit about $2 billion. Since then, they've now grown to become a leader and dominant player in the commodities sector, with a market cap now well over $80 billion. ICE originally was built as a tech platform. I think a lot of people don't know that. They had no exchange, nor a clearinghouse when they went public. For clarity, I'm not suggesting Abaxx is going to 80 billion, maybe yet. But if you track ICE's history along with their corporate strategy and focus, I do see multiple comparisons to the Abaxx model. Brilliant group identified a commercial need, a huge market opportunity, and built the solution. It is my belief at this stage, Abaxx represents a unique investment opportunity and is very, very scalable. I will now hand the floor over to Mr. Josh Crumb, the founder and CEO of Abaxx, and Joe Raia, the Chief Commercial Officer of the Abaxx Exchange. They'll each provide you with a corporate update. Josh and Joe, if you can each please take maybe 10 or 15 minutes to update us, and I'll hand it over to you, Josh, now.
All right, thanks, Neil. I appreciate the intro there. And again, I also want to remind people of forward-looking information and statements. Particularly given we are early stage and have now launched. So of course everything is a bit forward-looking. So I'd also recommend everybody take a look at our risk disclosures on the financials that we just put out last night, as well as the normal risk disclosures. But stepping back again, the purpose for doing the call this way, of course, we had a formal investor update just a few weeks ago after the launch of the exchange. So we're kind of in the middle. Of course, we did put out new financial statements overnight. But really, we're looking to probably the November financial statements to start moving to a more normalized reporting cycle of key performance indicators and discussions of revenues and earnings and if we're in a position to provide formal guidance to the market, that reporting cycle would likely start in November after our Q3 financials. So, again, so today we thought we would actually spend much more time on just a general Q&A. Now I'm happy to update a few of the key highlights, over the last 5 weeks. Just for those, that obviously want that level of detail. But then we'll turn over the call much more to general Q&A, because I know we didn't get a lot of time to do that in the July call. But again, stepping back to what we built here and where our vision is. Neil mentioned ICE in the intro there. We actually know there's a few members of ICE on the call here today. What Jeff Sprecher has built is pretty incredible, and of course Jeff Currie was at Goldman in those early days. And Goldman was a key part of that growth of ICE. And of course, Joe Raia and Dan McElduff were also, having launched the Clearport at the NYMEX, were also in that sort of foundational transformation of commodity futures markets, when the NYMEX went from less than 10 contracts trading in pits to thousands of products cleared on Clearport. So clearly the last 20 years has been a very very interesting time and growth, global exchange consolidation, and of course the whole technology wave that took, again, regional pit trading to global financial trading. So, but we don't think that is that whole transformation is done yet. For all of the innovation that's happened, in the screen and the access to markets, post trade, clearing collateral, there's still a lot of innovation to go to truly grow markets to the potential where they think they are. And even if you look at the energy component of the traditional exchanges today, this renewed commodity investment cycle and volatility cycle has seen energy contracts cleared on exchanges like ICE Clear has been compounding at about a 20% CAGR. But with Abaxx, it's also important to show that we're not going head to head in these exact markets. This is very different than, say, launching a new equity exchange that maybe, or alternative trading system that's trading the same securities in maybe a different format, trying to take market share, and what generally ends up becoming a bit of a race to the bottom. Abaxx has specifically been built to look at new markets, changing market structure, and where we think there's opportunity in, as Dan Yergin calls the new map, this global changing energy map, is going to open up new opportunities. And so really that's what we're looking at is maybe some of the harder to develop, coming from a mining background. I guess I maybe think of myself as an exploration company, looking to develop the new markets. That's what we're doing. Now, there will be another phase where we believe our technology will allow us to gain market share against competitors by doing by adding value to clients that maybe doesn't exist in the current exchange and clearing landscape. But in the early days, we think there's plenty of opportunity in just finding those markets that are maybe overlooked, or we've got a different approach given the experience of the commodity team on the call today. So that's the vision for Abaxx, and of course we can get into more details since launching the exchange on June 28th, kind of how the first 5 and 6 weeks have been going. I'll turn that over to Joe to do that. But before we get there, specifically, I do want to address, I guess, the few formal KPI updates that we have since our July call. Of course, our financials came out overnight. We do not show any new exchange revenue. Of course, we only launched the exchange with 1 trading day before the end of the quarter. And so we did not include that revenue for materiality, and we'll start picking up the revenue metrics in the future. But I do want to point out, of course, we did become revenue generating with our royalties starting last year, and this year with the base carbon royalties, as well as our port royalties on the iron assets. We are pushing up close to $1 million in annualized revenue on the royalties. which is not nothing as far as covering a lot of our non-exchange OPEX. And of course, we look to see that growing as well. So we are still in the early stage of revenues, but we'll talk about the fundamentals that will drive this growth now that we've launched. As far as the onboarding status is gone, for good or bad, I kind of call it. We opened a store, a very difficult store to open on a very difficult island to get to, with the moats, and we've got a few ferry services to that store now, and so really over the next year, it's about adding the bridges and tunnels, the connections to that market. Of course, we've got a deep product pipeline of products we want to launch in that store, but really over the next 4 quarters at least, we're going to be just growing the connectivity and again the access to that market, and that's really what the next few quarters will be all about, and even just since we launched at the end of June there, I want to explain, kind of why we launched at the beginning of the summer, and even why we didn't end up launching earlier in Q2. And again, it's really about some of the things that are a bit out of our control of the onboarding and back office processes. And we wanted to make sure we had the exchange launch systems working, even if it had limited access, so that we could spend the summer onboarding all of those initial infrastructure partners that we mentioned in the launch press release at the end of June. So just a quick update on that. Of the brokers getting connected, we have 6 onboarded with 10 in progress. The market makers, 7 onboarded, 2 in progress. Other liquidity providers, 2 onboarded. Trading firms, 5 onboarded, 15 in progress. Non-bank clearing members, the 2 direct clearing members that we've press released, as well as 1 more indirect FCM with another one in progress, and then a bank FCM that's also in progress. And I'm sure we'll talk a little bit more about the importance of getting the banks in as well for increasing risk limits in the clearinghouse from some of the big corporate, particularly the commercial traders. So that's kind of the high level overview. Well, I'm sure go through a lot more in Q&A, but maybe I'll turn it over to Joe now to give some of his first impressions of the first 5 weeks and kind of the momentum and excitement as we head into September of getting the rest of that list onboarded.
Yeah, thanks, Josh. And I think just real briefly, and certainly we can address a lot of the details and the questions, but just broadly, the launch went better than expected. We had no issues, and having gone through launches of various technologies while I was at the NYMEX and the CME, and some of the issues that we always had back then, we were really pleased that everything went very smoothly when we went live on June 28th. We had bids and offers and trades in both block markets and on the central limit order book via TT and CQG. Our 2 ISV partners. We traded both on the central limit order book for LNG, the Gulf of Mexico contract in the spot month of October, which, by the way, was the first time any LNG futures contract physically deliverable traded ever on any exchange. And we continue to have markets in those contracts, in that contract daily. We traded also a block trade in LNG and through our broker partners, and then also traded carbon. And so again, important to note that the carbon markets and the voluntary carbon markets have had their ups and downs over the past few years with issues in reliability and quality. And we know that the contracts that we've designed in both our CORSIA Phase 1 and our jurisdictional red contracts have deliverable supply, which is unique to some of the other contracts in the marketplace. And we know that the marketplace has confidence in those contracts by the way they've traded them. And we have markets up continually in both those contracts going forward and as we speak today. As you mentioned, we have market makers in both carbon and LNG. We're continuing to onboard the market makers in those markets and see a lot of positive inbounds from clients just about daily now as we're going through the summer, that they see that the exchange has launched and that the clearing firms that we have on board have been reaching out to their clients, and there is a distinct demand for trading these products, and that's a very positive sign. Again, we can't forget and lose sight of the fact that this isn't just new products that we're launching or a new exchange that we're launching. It's a new clearinghouse. It's a totally new risk system that hasn't existed in the marketplace for many years. And to have the confidence of not only the trading firms that have to onboard us as a new exchange, and it's the clearing firms that really control kind of the keys to the kingdom. And so if the clients bang on their doors hard enough, eventually they come to us and say, yes, we want to connect with you. And we've seen that now continually through the summer, not only with the existing clearing firms that we have, but the ones that are now starting to come to us and look to onboard with us. So we're very positive about that. Again, the market shouldn't lose sight of the fact of the importance of the clearinghouse. It's so difficult to launch. It hasn't been done. And for clearing firms like our two main partners right now, and the third that's about to onboard with us, for them to put up their chips on the table and say, listen, we believe in the systems that Abaxx has developed from a risk system. We believe in the regulatory oversight of the MAS of Abaxx. That's really an important step. And know that now that we've launched, as you mentioned, Josh, we have a very robust pipeline of new products. We're continually hearing about new products to launch just about daily, and we're working really hard internally and with also the trading community to bring those new products to the marketplace. And we know as we increase that footprint or that surface area of Abaxx in the marketplace, we know that the products that we'll develop are different than the other exchanges have, which is a good thing, because we know that there's demand for new products out there that the existing incumbents haven't addressed, and we know we can generate really good interest in risk management systems for those products on the exchange. I'll stop there. Great. If you want to go into
thanks,
questions.
Joe. And maybe I'll turn it over to Jeff. I guess first off, what were your first thoughts when we traded that first, LNG contract, and your view of the global energy landscape and commodity landscape as we enter this new vol cycle, new investment cycle, new map, whatever you want to call it. So maybe Jeff.
Great. No, I was super excited to see that. I think a new exchange, incredibly welcomed in the market. And I think the focus on green commodities is going to be critical, because that's where all the growth is going to be. I like to make the point that, I deal with people quite often, they go, oh, well, net spec length is at the max or at the minimum. During the 2000s, during that super cycle, we saw spec length reach new highs every single week. Why? Because the markets were growing during that super cycle. And I think people forget about that. There's not like a cap level of spec length and it's, the max. It should be growing. And I think that people haven't seen it grow since 2011, 12, and they probably haven't looked at the data back then. They forgot that, hey, these markets need to grow when you actually start to grow the investment. And I stand by the view we're going into a super cycle. I like the term a supercharged CapEx cycle. What I want to do right now is just spend a little bit of time addressing why hasn't it worked for the last 2 years. We look at many of the assets that are old economy. They've done nothing but trade sideways for 2 years almost. And actually, where it happens, it corresponds almost exactly when the rate hikes begin. And I've been sitting there scratching my head, and you look at oil fundamentals this last week. They were incredibly tight, yet we saw positioning. I've been doing this 30 years. I have never seen commodities in aggregate go net short. They went net short last week. We're not in a recession. China slowed down, but I really don't buy that explanation. What's going on? Why won't people buy this sector? And I think there's several reasons for it. One is if you think about the risk-free return at 5%, 5.3, I think it is today. If you just assume, a constant absolute risk aversion type structure, that means you need to get at the 25% vol market, you need to get 6.5% more on that 5.5%. That's a 12% return. And when we look at all these old economy industries, they're struggling. They can't hit that hurdle rate in the current environment. That's part of the reason why people don't buy it. So they're not going to buy into this until you're running over the top of the pothole. So that's reason number one. Reason number two has to be with the banks cut back on the amount that they apply towards risk management. And I don't think that's going to change until you get the demand from those making the investments in the green transitioning, because you don't have deep forward markets in the current environment. The people can't hedge out that risk, and you don't see it. In fact, I used to love this chart that showed coal in the 2000s versus oil. Oil had deep forward markets, coal didn't. Oils throughout the 2000s went up with those forward markets pricing in the pothole they were going to hit in the future. And when you hit the pothole in 08, 09, they went through it rather okay because of those instruments that exist to allow them to hedge that risk. Coal, on the other hand, just traded sideways the whole time, kind of like oil is doing today, and copper and the rest of these green commodities, and you hit the pothole and went straight up. But what's going to get these people to come in and start doing this now? I think a lot of it, you're starting to see order books, for the CapEx beginning to happen. But we haven't scratched the surface yet. You just take like, energy investment. We estimate that it needs to double between now and 27, 28. The order books are up, but they're up maybe 25, 30% right now. We're not close to doubling. And as that demand starts to come in, these instruments like what Abaxx is providing are going to be in demand. I think that's going to be the critical point here that gets these markets up and running, is because it's not so much going to come from the investors. It's going to come from those corporates needing to make those investments to grow that underlying supply base. And also there's the transition part. You got to meet the transition. I think that's going to be a real critical factor that Korea helps create that new growth. The other one that's going to help it a lot is when those rates start coming down. Because if those rates start coming down, old economy investments start to look a lot more attractive, and we're likely to start to see more investment flow into the space. So, I'm not worried that we've seen these markets trading sideways. I think, the situation is, the order books tell you it's happening. And, I think, we look at most people who agree we're going to have to make large scale investments. You see that happen. I think we're going to be in a different place. So I still stick by the view. I'm not worried that, copper is still sitting at, $9,000 a ton. Oil's still sitting at, 82 today, the same levels they were practically 2 years ago. Because what we're seeing is that in order books beginning to fill up, which means that CapEx cycle is coming. By the way, one point I want to make here. What is a commodity super cycle? A commodity super cycle is a CapEx cycle. There's nothing else to it. So if we're seeing those order books fill up, that means the real CapEx. And by the way, people, when they do those order books, they got to put a 15% down payment on it, and then they get penalties if they back out. So I'm comfortable that those order books are going to meet, but 25, 27% increase in order book is not close to the 100% we actually need. So, and I think, there's going to be a lot of risk that needs to be hedged, and we're going to go back to that environment like what we saw in the 2000s, where, spec interest in, these markets and open interest is going to grow. And that's going to be the opportunity I think Abaxx is well positioned to take advantage of.
Thanks, Jeff. I appreciate that. And again, tying back, because that was the thesis, right? When we started building Abaxx, particularly Abaxx Singapore 5 years ago, we had a view of this structural CapEx cycle, and we very specifically went into the commodities that need that price transparency and that growth. Fast forward today, you look at liquefied natural gas. Of course, what we thought justified building a brand new exchange clearinghouse, all on its own. Of course, we've got a deep product pipeline behind that, but it was exactly that CapEx cycle. And where are we today? We see the LNG industry It's actually probably of all of the sectors is probably the one that has, got out in front a little bit of this CapEx cycle. And now we see this, this growth race between exports in the U.S. and Qatar, which I would actually say the liquefaction supply is now outpacing the visible demand and offtake, which of course plays exactly into our market structure thesis, that we need, that this market is going more to spot, more like oil or other traditional commodities, and which needs these forward pricing instruments, including our Gulf of Mexico contract when the market needs a buyer of last resort. And then, of course, our Northwest Europe contract and our Northeast Asia contract when the market needs a seller of last resort, to meet demand in various spikes. Again, it was, speaking of ICE, we will go back to a lot of that today, but they actually put out a great paper on the changing market structure of global gas over the last few weeks. But they talked about onshore U.S. gas, pipeline gas. They talked about onshore TTF gas, and then they talked about a survey index and JKM. But so when markets are relatively calm, sure, those instruments may work for LNG on water. But the perfect example is what happened in 2022 when an $8 spread, $8 MMBTU spread opened up between TTF and regas in Europe, and all of a sudden that was not a very good hedge. So we need markets very specifically when we need those hedges. And so we still believe that, and we've had great feedback since we've launched of particularly the majors that have been watching us for years, watching our market structure develop with the industry. And now that it's live, we're in a very, very unique position in that whatever they thought about it, it's theoretical. But if they end up selling an LNG cargo and you've got open interest and you've got a market for that same product, it becomes a matter of best execution. And so we will see that liquidity will get liquidity because we have a physical product, and best execution becomes the name of the game, even for the largest players. So again, we see a very, very clear path forward. Nothing has changed since we started this thesis, and it's only getting stronger as this CapEx cycle grows. Neil, at this point, do we want to turn it over to Q&A?
100%. We've been amassed several questions for two things. We've been telling people about, obviously, the upcoming investor call as we finalized that over the last week or a couple of weeks. So we've been kind of asking everybody to be patient. So we've got quite a few questions here. We'll try and get, guys, to as many as we can. There are some time constraints. So if we can't answer them all on this call, we will ensure that Josh or Joe or Jeff or the appropriate party will answer them and we'll email them to you. So on that note, I'm going to hand it back to Jan.
Thank you, Neil.
And Jan can start asking some questions. And then some are for you, Joe, and some are for you, Josh. We've also got some questions online, so we'll try and get to those as well. But these initial questions have come in from investors, portfolio managers, and advisors over the last few weeks. And I'll hand it over to you now, Jan, to ask these gentlemen the questions.
Perfect. Thank you, guys. So the first question is for either Josh or Joe. How does Abaxx plan to sustain and grow these market activities in the face of competition from established exchanges?
Yeah, sure. So we touched on that a little bit. That again, we're very specifically launching new products that are not just lookalikes or something very similar to what's already out there. So as Joe mentioned, we are the first physically delivered LNG trade. And so that's again where we're starting, is where markets we think have been maybe underserved, maybe a little bit more difficult to develop because it's really spending a lot of time with the physical industry and maybe less with the the PRAs and the bank side. And again, I want to point out, just for relative scale again, ICE Clear, I think, just cleared 1.5 billion contracts last year. That's about 6 million average daily volume. And our break even is somewhere around 20,000 contracts a day. So again, that's order of magnitude, but of difference. But again, we think that the pipeline of products that we have So we've got, between the 3 LNG markers and the two carbon contracts, we've got 5 today. We believe we should be, at or over, 10 contracts by the end of the year. And this initial suite of contracts, would we believe the TAM on these contracts are in the order of 1 million contracts a day as these markets mature. So again, it's going to take a while of connectivity, building that liquidity, but certainly we believe we're in that range, and we wouldn't have put all of this work into building a new full stack clearing exchange, clearinghouse technology if we didn't think we have a medium term potential for 1 million contracts a day. But again, just the first benchmark we got to get to is about 20,000 contracts a day, and that's what we'll look to do over the next year as we build connectivity to the market. But Joe, do you want to talk a little about where you see opportunities and how we grow these markets?
Yeah, I think that the LNG market is without a doubt a market that's been overlooked by the existing exchanges. We saw 5 years ago the change in the structure of the marketplace from term contracts to spot markets, and also to optimization of markets, especially recently. And we know that from firms that we're maybe trading in the OTC market, want to look to the exchange for both anonymity in trading and getting actual real value for the product, right? They say, listen, we have a relationship in the OTC market. We just don't want to go out there and kind of get our faces ripped off, so to speak, to use a kind of a trading term, by trading OTC. We'd rather put our bids and offers on an exchange, knowing that we can get fair value for LNG or for nickel sulfate or for lithium or whatever. And that's really, and LNG is really one of the most important things, especially as this market now starts to get, as we like to say in the exchange world, crowded. You start getting more and more firms coming in and saying, I'm a medium-sized firm that's delivering LNG, maybe 20 cargoes a year into Northwest Europe. I just can't go into the OTC market. I may not have a credit facility with a big firm. I may not want to do an OTC contract. I can just put it on the exchange and know that when that contract settles every day, I'm getting actual fair value. And that's really the big difference when you look at the OTC markets and when it started out in LNG or others, and how we're moving now to a more crowded or more populated marketplace. And we see this from the inbounds we get literally every day now from firms that are saying that to us, that they want to trade on the exchange for the fact of credit mitigation, risk mitigation, and price discovery, all the 3 things that are the foundation of futures markets. And that's exactly why we built this, why we built our clearinghouse, so we can address these issues and particularly address the marketplace's concerns around transparency.
Thank you, Josh. Thank you, Joe.
Joe, let me interrupt. Joe, just comment on one thing. 20,000 contracts a day, Josh. Joe, you said to break even. Target is within a reasonable period of time, 1 million contracts a day. You've done, and Josh, and Joe, I've heard you talk about, to put in perspective, I mean, those are not big numbers in terms of, I know ICE does what, 25, 27 million a day. LNG, we looked at, maybe you can just talk about, again, I'm not saying you can necessarily do this, but if we've looked at aluminum, and Josh, Joe, we've talked about this, and we've looked the size of these markets. Aluminum does, Joe, what? Josh, 240,000 a day?
Yeah, something like that.
Pretty much so, yeah.
Jen, do you want to throw up slide 20? We've got some of the key futures markets out there. In fact, we've updated this.
People put this in perspective. It's not a big number.
Yeah,
we're talking.
We'll get an update put out on this. We've actually done the work, very recently for, some of our strategic investment process. And in fact, Brent crude oil is now over 1 million contracts a day and has surpassed WTI. But yeah, I mean, aluminum, we have down there at 265,000 contracts a day. And remember, just for context, it varies by region and everything else, and obviously size of your contract. But in general, the revenue per contract, in the industry is somewhere around $2, sort of $1.50 to $2.50. In the early days, we're actually gonna be much higher than that. on our early rack rate, for our prices. But industry at scale, is somewhere around $2 per contract. So again, when I referenced ICE Clear Europe, clearing 1.5 billion contracts, that's somewhere in the 3 billion a year in revenue, and these companies and these contracts trade about 10 times revenue, or somewhere in the 20 times EV/EBITDA range, right? So these are just having one of these key contracts, of course, is a company maker, and worth hundreds of millions, if not billions, when you get into that range. So Dave Greeley, in one of our older presentations, kind of did the TAM and the fundamental outlook for the LNG market, and we do think that's a larger than an aluminum market, and maybe not quite, conservatively not quite the oil markets, but between that 250,000 and million lots per day. But that's just LNG, right? But what our vision is really building something like a NYMEX, the more integrated gas and power market of the U.S. In Southeast Asia, right? And that's not going to happen as one survey index like JKM being the hub for the entire region, and billions of people basis energy in global gas. We need very specific deliverable markets, spreads to onshore pipeline, third-party access markets, just building that whole ecosystem, spark spreads, that all has a lot of development to go, particularly in Asia, which is why Abaxx is based there. And this is, again, we still see structural growth in these markets for another decade to come.
That was great. And then just one other thing that I thought was really
Sorry, Neil,
important.
did I answer the question there?
Yeah, you did. That's great. Now, then the other thing I just want to comment on that was really important to me, and again, as I mentioned in my intro, that I speak to Josh pretty regularly, and it's the insight and education I've gotten from Josh has been just overwhelming. Because the other thing I thought was really important is these products, Joe and Josh, are typically these are like your clients coming to you saying, like, I want LNG, I want nickel phosphate, so it's not you building it and they will come. You've already got the interest. So a lot of the products, Joe, right, you're developing, these are the clients onboarding
Correct.
with your company, with the exchange, saying, we want you to write X type of contract. So you're kind of doing it, I think, a better way by having that demand. Is that a fair statement, Joe or Josh?
Yeah, it's like the way we did it back in the NYMEX when we built the Clearport product slate. I mean, we listed almost 2,000 contracts there because the marketplace was telling us, and ICE did the same thing. And it's a you don't want to build it in a vacuum. You need to get buy-in from the community. And we did that with LNG from the start. We did it with nickel sulphate when BHP came to us. We're doing it in carbon and other products that we have in our pipeline. And I think it's important that you do it that way. That it may not be okay, we're going to trade it when you launch it, but we help create the product. We got the feedback on specs. We're doing that now in some of our battery metals contracts, and some of the firms that are coming back to us with feedback is quite amazing. Actually, it is the big names in the industry, and they see an opportunity to get transparency. I go back to transparency all the time, but transparency and in for the products that they want to trade and manage their risk on. And that's really a big deal. It's not it's not build it, as you say, and they'll come. You have to build it with a partnership in the marketplace. I mean, you always cross your fingers and they'll follow through and trade it. And there's a lot of things in onboarding now that are so different now than they were 20 years ago when we built Clearport and ICE Clear started. The onboarding process is extremely onerous now. Again, especially for a new exchange and clearinghouse. I mean, they're looking at us and saying, okay, who are you guys? What's your risk systems? What's your capital background? What's your, how are you structured? And it takes a while for onboarding. And it wasn't unexpected. We knew it was going to happen that way. The clearing firms, though, are really, again, the gatekeepers. And the fact that we've had clearing firms that are onboarding with us is nothing short of, as you said, I think in the beginning, Neil, almost impossible. The clearinghouse structure and building it is almost impossible. There's a reason why there hasn't been one built in several decades, because it is literally impossible to do. And in this marketplace with over regulation and scrutiny on regulation and just from every aspect of the world, not just in the US, you really have to have your your act together to get the clearing firms to come on board and put their confidence in us that we can manage their customers' risk in addition to the markets that we're developing.
That's great. No, because it seems like you did the impossible almost getting this, because that's why I'm assuming nobody's done this in decades. But it also
Exactly
creates an incredibly more valuable entity. Just sheer licenses alone. I mean, like you just can't.
Well,
Like
you look at the margins.
barrier to
You look at
entry
the
is almost
margins. Yeah.
right.
Yeah.
So,
The
anyways, I'm gonna
margins
go ahead and
are,
back.
I mean,
Go ahead.
yeah. Yeah, let's just say the margins, you look at the margins at exchanges. I mean, all of the costs that we put into the building the clearinghouse for the past 5 years is sunk cost. To launch products, and just from my experience at the NYMEX and the CME is pretty low, if not I would say some would say it's zero. It's as close to zero as you can get. The margins are very substantial on and lucrative on exchanges. And if you look back to both CME and ICE margins on their statements, I mean they're probably in the 60%. I would say from the NYMEX back in the day, we were 70+% on the margin side.
Perfect. Thank you, Josh, for that. The next question is
Yep.
for you, Joe. Can you share any feedback or insights received from early adopters of these products, and how has Abaxx addressed any of their concerns, if any?
I think the feedback from the product side has been very positive. I think the LNG contracts are, I mean, and that's I think verified by the fact that it traded. The Gulf Coast contract traded. The Northwest Europe contract, we've had firms that are onboarding specifically to trade that, and we know that the Asia contract will definitely trade because of the interest from the Asian marketplace, particularly up in Japan. With spark spreads that are now could be traded against the power contracts that are traded in Japan. But interesting, some of the anecdotes that we've gotten from Asian players are like, why am I taking delivery of LNG in Japan that's priced against Brent crude oil that doesn't even have Brent crude oil in it anymore? So it's really an interesting, kind of a revelation to some of these firms that, yeah, why am I trading an LNG contract based on Brent crude oil? That makes zero sense. Now, with all due respect to ICE, who has a great benchmark in Brent, but it doesn't have any correlation, zero correlation to waterborne LNG, and that's really where the demand is. And we see the the product being definitely accepted by the marketplace by the fact that they're trading it. I would say the same in carbon, and I think even in nickel sulphate and our other battery metals that the inbounds and the participation in the working group structure of developing those contracts is the way we built LNG futures, in the same in carbon, and we'll do the same in all the other products that we'll be developing.
Thank you, Joe. Now let's shift to the technology side. The next couple of questions are for you, Josh. Can you elaborate on the proprietary technologies or innovative approaches that differentiate the Abaxx trading platform from its competitors?
Yeah, so I'd probably put this into two categories. One is our technology stack today. Building a fully EVM cloud deployed stack, and not just in our core clearing and central limit order book and market compliance software with our vendors, but also having the latest ISV cloud integrations and right down to Swift and everything else. All of these companies have been upgrading their systems over time. So I would say in totality, like we have the most advanced cloud system, mostly just because we built it in the latest iteration. In fact, when we started this project working on the old Snowbird NASDAQ software, that wasn't the case. So right, we if some of the investors recall, we actually made the decision which probably cost us at least 6 months, if not a year, to because of some of the regulatory delays and volatility market delays in Europe, we decided to actually upgrade and take some risk and throw out a stack that was sort of 90% built and build a new one. So the advantages of that are, one is faster connectivity for new members that are onboarding, because they can use the the latest version of their ISV stacks from a pure software perspective. Now, of course, there's still the risk, regulatory, other InfoSec concerns, but the actual deployment is much faster than it used to be in connecting to a market like ours because of it. The second advantage we have is just cost, right? The fact that our operating costs are so highly scalable, as we launch new products, our OpEx doesn't really change, because so much of this infrastructure sits with the hyperscalers and all of the innovation that we're getting in open source software and so forth. So just given the nature of our stack, we've got a much cheaper way to operate than most of our global commodity competitors. So that's just version one. It's an OpEx and it's a time to connectivity advantage versus competitors. And again, we've seen large investments from the hyperscalers, like Google investing in the CME group, like Microsoft's partnership with the London Stock Exchange Group, and again, these are multi-year projects to get their cloud ops to where we are today. So that's our first advantage. But we obviously want to take this to the next step, and this is why we built Abaxx. We built Abaxx for that next step. And that next step is what we've already embedded in our stack around data lakes, and the way we'll integrate AI and machine learning, and as well as, of course, our digital identity, the core of our digital identities infrastructure, which we believe is key to actually having a fully digital title. This fully digital title where you can start using the underlying commodities, particularly as real-time collateral in your clearinghouse. Now, again, I want to caution, none of these products are yet approved by regulators. This has been a long-term development, but this is exactly why we built Abaxx. Just as ICE built their platform to disrupt the 5 or 6 contracts trading and constrained by pits, we built Abaxx because we believe the physical market is constrained by the collateral that you clear in a clearinghouse. So we think more and more products will be opened up by bringing this new innovation. And where we have that advantage is, again, we believe a lot of our competitors are going to have a full stack, third-party integration, large studies, large transitions. But we built those next generations of technology natively in our stack. And you'll start seeing pieces of that infrastructure roll out as soon as this fall, where components that make that full digital title work will start rolling out this fall. And so that's our technology advantage. First and foremost, Abaxx was built to solve those problems. Now, we saw the traditional market opportunities even without a fully new stack. But again, we didn't put in the last 5-6 years of our life to get to 20,000 contracts a day. First it's to get to 1 million contracts a day, then it's to introduce technology and go far beyond that.
And just to add, Josh, just so I'm clear, because we talk, and by the way, thank you, because Josh, I'm not the techiest guy, everybody, but Josh has really done a great job of trying to explain all this to me. The applications are not, you built it for the exchange, but there are multiple financial, different industries, different sectors and verticals that this technology could be utilized for. It wasn't, you're using it for your company, but the idea is this technology could potentially apply into a variety of different verticals or different types of businesses, correct?
Yeah, absolutely. Look, I would say today we're only constrained by capital. Right. We have the technology, we have the human resources, we have the network, we have the regulatory licenses, and today, if I'm going to speak frank, our cost of capital price is zero. Near zero, probably sub 10% probability of success on our traditional markets, and near zero on our technology. So of course we're in the prove it stage, and that's what we look forward to proving. But yeah, that's why we built this business 100%.
Perfect. Thank you, Josh. Two-part question for you. How does Abaxx ensure the security and reliability of its platform, especially in the light of increasing cybersecurity threats? Additionally, what role does artificial intelligence or machine learning play in enhancing Abaxx's trading platform?
Yeah, so cybersecurity right now is, I think in the latest FIA conferences, it's usually the number 1 or number 2 risk that firms highlight. So clearly that's and of course we saw the CrowdStrike issue take down a few players in our industry just recently, and then one of the ISV issues last year. So look, this is an ever evolving challenge, and I would say that was actually one of the hurdles in some of the time delays of onboarding new clients. But again, I think one of our advantages is our cloud infrastructure and being on the latest stacks, whether there's the latest amount of innovation and the latest amount of open source, coming from the hyperscalers in particular, that gives us a whole nother layer of defense and innovation that's sort of off our balance sheet. So that's a key in the way we've deployed our technology. And then I guess I would also emphasize that identity and access management is one component of verifiable credentials and the ID++ stack, that is a whole new system with a lot more contextual access and security. InfoSec and IT is very important. And again, this is where we believe just the way we built Abaxx, where we always keep software innovation, as we say, in the front office. We don't see software as an IT as a back office thing. Like we are in the world. Markets are nothing but information technology. So we always keep that in the forefront of our business model, to always try to stay a step ahead of competitors. So that's key. As far as artificial intelligence, particularly if we're thinking about generative AI and large language models, I'd probably refer back for a longer discussion. We don't have a lot of time on this call. But we are the two-part series we had on smarter markets on around New Year's and Christmas. We talked about that, so I'd probably refer people back to that. But I guess again, the key setup is the way we've built our data stores and our data lakes. We do believe we've got infrastructure to handle this innovation, particularly as more and more people move to open source AI models. And then have proprietary RAG type setups. We're very well set up to do that sort of thing. So as innovations happen off our balance sheet, our infrastructure allows us to integrate that very quickly.
Thank you, Josh. What steps is Abaxx taking to ensure financial sustainability and return on investment for shareholders in the current economic climate? How does Abaxx prioritize its investments in technology versus market expansion? What criteria is used to make these decisions?
Yeah, so just first on the budget of tech versus and I want, again, innovative tech versus our core OpEx and our core CapEx. Over a third of that was software related, systems related. So obviously tech is already the core of the operations. But then we also have Abaxx Technologies, which is much more the deep tech innovation arm, and it's still running at about 10-1 of our budget allocation of exchange to new technologies and that. So again, very undercapitalized for what we're trying to do, to be frank, and we need to change our cost of capital to be able to actually execute on the broader vision, particularly for ID++ outside of the exchange. So on that note, we have talked about looking at strategic investments at the subsidiary level. Again, we take this approach, much like a exploration company that joint ventures projects and brings in partners at the project or subsidiary level. And we think that's the better way to unlock a better cost of capital in these businesses, given the stage of our business. So we've taken strategic investment, of course, at the exchange level, and we'll continue to look to do that. And we're also looking to take in investment strategically at the software level, because we and unlock more of that value and a better cost of capital. And then as far as the financial sustainability, again, it's all wrapped up into the same thing. Right now, I always like to say our human capital is orders of magnitude greater right now than the market's affording us on our financial capital. So we've got to do what we can to unlock it. And that's what we plan to do.
Perfect. Thank you, Josh. And the final question for today is for Joe. Joe, what are Abaxx's plans for expanding into market presence globally, and which regions are you currently focused on? And how does Abaxx plan to address any challenges associated with entering these markets?
Sorry, I was on mute there for a sec. I think that, it all comes from, as we said earlier, from inbounds from customers. We are in global markets already with our Gulf of Mexico contract, our Northwest Europe contract, and North Asia Pacific contract in LNG, and certainly in the global voluntary carbon markets. And the participants, interestingly, have come and traded from outside of those regions to trade those products. So I think that's a testament to the development of the contracts. We obviously haven't put out any info on the upcoming contracts that we're going to be launching, probably except for, say, nickel sulphate, which will be coming down the road, and probably an additional battery metals contract in lithium. But again, as we talked about, I would say also that, we continue to get inbounds from customers asking us to look at products that the incumbents haven't looked at for a lot of different reasons. So, we feel that we're well placed both with the clearinghouse after taking all the time to build the clearinghouse and with our clearing partners and clearing firms and broker partners and trading partners to develop these new markets. And they put a lot of trust in us and faith in us to be able to do this. And I think it's a testament to our team, as Josh said, human capital wise, we're as good as anybody that's out there right now.
Thank you, Joe. And thank you, Josh.
Yeah, Jan and Neil, I see that we're getting close to the top of the hour. I'm happy to keep going, but just for those that have hard stops, is there any other key questions you want to prioritize?
Well, maybe I could ask a couple. There are a couple others, but maybe we can comment a couple things that I've been kind of keeping an eye on, and I've got emails and text messages while we've been on this call just about some things. So one thing I know has been brought up. So just so everybody knows, Josh just came back from Boston. I was invited to speak at the Canaccord conference, their 44th annual Canaccord Genuity conference. Was an amazing event where Josh spoke to a large audience, mainly institutions, had several one-on-one meetings, and in that also met with some of his existing shareholders. But I think there's been a lot of interest. Say, are you raising more money? Because some of these guys want to write some, what I understand, are interested in writing some significant checks simply because they can't get that kind of position on buying on the open market. I'm of the belief, Josh, that the company at this point has no intention of doing any type of immediate raise at the current valuation. If the stock went 20, 30, 40, and I'm not speculating it will, I'm not here to provide that guidance. I'm just saying, I just want to make
it clear. Let me without jumping to that, let me
yeah,
just,
can you just, this is coming up
so,
now during the call a bit.
Yeah, look, that by the way, that was pretty much the key question that I had with all these institutions, right? institutions that want to build a $2 to $20 million position, and think that they can get that at this price. Again, that in my mind is sort of math that doesn't work, right? Because look, even if our break even takes longer than we would have liked with some of these onboarding delays that we've seen the last quarter or so, our business is a pretty sustainable 20 million a year OpEx right now. So you're only looking at a couple quarters delay is like $10 million. So the short answer is no, there's not going to be room without buying in the market. But beyond that, again, I would look. Plan A is to execute on the strategic round and the discussions that have been ongoing at the subsidiary level, where we can structure things in different ways. And by the way, not dilute what I personally believe is the bigger part of our long-term business, which is the technology held in the parent company, as well as the royalties, base carbon, which is insanely undervalued, and so forth. So again, we do not look to dilute at these levels. And we have mechanisms. If you look at the financials we put out last night, again, using US dollars, roughly $25 million on the balance sheet, and roughly $5 million a quarter OpEx. And we obviously do have our 10 million in guarantee funds and other regulatory requirements. But look, we're in a position, access to capital, and sort of current plan A through the end of the year. And obviously we want to, we expect a very exciting fall with more onboarding and growing our markets. And that's where we want to hit the strategic financing. So that's that's the current plan. And yeah, look, I just refer back to Canoe, right? I mean, when we were financing last year, we had firms stringing us out, not Canoe, string us out for a number of quarters, wanting us to de-risk everything and still get a $6 price. But of course, the firms that stepped in first took that transformational capital off the table. The price almost immediately doubled. So again, you don't get de-risked and current prices. And I would say it's similar for institutions today. That was the big part of the conversation I had. But yeah, I mean, but again, one more point that I think is quite important here. There's two ways to look at us, of course. I'm taking, both sides of the spectrum. One is, we're at, somewhere around $1 million run rate right now with 20 million in OpEx. We're very early, and in a prove it market. But, so looking at that, our valuation, I would say, there are integrated exchange clearinghouse stacks that I've understand are on the market for over our market cap just for licenses and infrastructure. So I believe we're trading very close to salvage value, which means we're trading a very low probability of success and any of our forward value. So one investor may look at it, of, hey, you're too early in revenues for a larger market cap. But the other way you could look at it is our ongoing dilution is less than 5 million a quarter. And so all of the major capex and the biggest challenges are behind us. So what's the probability of success on 1 million contracts and forward? So that's the debate the market's in right now. And of course,
that a debate?
Unlock it.
I used to have a $2 billion market cap in 05 with nothing. Like I'm not discrediting. They did, like, they're a brilliant company. But I mean, if you want to go to apples here. I mean, they had $2 billion as a trading platform with, again, limited, no clearinghouse, no licenses really in that respect. And again, they were trading at what, 10 times your market cap. So I think, again, you can play both sides, but again, I'm completely biased, everybody, by the way, because I own a lot of stock. Been buying more today too, by the way. I think it's a gift at this price, but I do think you can make a fair case that you're not giving a lot of credence to this company's ability to grow and scale over the next several years and what the value of these licenses really are worth. And I think that's kind of your point, Josh, that you can't build these. Joe, you mentioned the same thing. It's impossible to build these. So we're going to close it off on this point. I just want to make a couple closing comments. First and foremost, I do want to thank you, Josh. Thank you, Joe. And thank Dr. Jeff Currie for joining us today and updating everybody. We want to try and move with a high level, keep it fun, keep it exciting kind of format going forward. I've seen some posts already, and I want to say thank you for those kind comments to Investor Cubed. Just want to make one final thought here that is really important, especially again, I'm a buyer of the stock. Stock's, been trading in the 11 range. Saw stock come off and hit an all-time high about 17, I think it was 1734. Obviously, I'm assuming there's been profit taking. Stock's kind of corrected. With the market cap under 400 now, and Josh and I had the same call, just to digress, at $6. And I thought that it'd be the last time we'll get a shot to buy this back in November. It was very upsetting to Abaxx management. The stock was even trading at that level. And Josh, you were right. The stock has never seen $6. And this is not Josh talking. Now, this is my personal view, is that I think it really is a good time. Again, high risk. Of course, you got to speak to your advisor, all the proper qualifications. I just think this is a great entry point. I've added significantly to my personal position at this level. It paid 11, 11.20, 11.30. I think it really is something that should be looked at. If you are an investor, it's a great time to add. And if you're not, this I think is a good time to get in. So we're very, very excited about today's call. Again, we want to thank everybody.